Last year, I invested $50,000 into Palantir stock. I made certain to put my money where my mouth was because I was touting Palantir stock quite a bit in my videos last year. And that investment is now worth over $110,000 today. But not to outdo myself, I also lost $20,000 on Disney, where I definitely was not feeling the magic. It's just a reminder that not every investment wins every year. But in today's video, I'm going to review my top 4 AI stock that should continue to have strong growth based on their current demand. And they're on my short list for buying this month. I need to point out that I'm not giving any advice. I'm merely sharing what I'm looking at and the reasons why. And as a quick reminder, all investments carry risk, and make certain to buy on the dips, and please also do your own research. For those of you looking at AI stocks for the very first time, the adoption lifecycle for technology tends to start with a foundation of semiconductor design and the manufacturing. I speak to this quite a bit with NVIDIA, AMD, and Intel, as that has definitely shown in the past year's stock performance. The next layer for expansion is from infrastructure, leveraging these semiconductors to be used more broadly at the enterprise and the commercial level. And that funnels directly into the third tier, which happens to be the software applications that bring the AI models and tools to life to the broader audience. This is merely used to illustrate the timing of technology and why we're going to be focusing mostly on the first and the second tiers of opportunities today. My first company on my list is ARM Holdings, which is a British semiconductor and software design company whose primary business is in the design of CPUs that implement the ARM architecture. ARM stands for Advanced RISC Machines that competes directly with the x86 architecture that most of us run on our computers with Intel and AMD processors. But that is quickly changing because Microsoft just released their Copilot PCs that are AI-enabled using chipsets based on the ARM architecture. Sadly, none of the AMD or Intel processors met the neural processing requirement of hitting 40 trillion operations per second. But the ARM-based CPUs, well, it did. In fact, Intel and AMD are only around 10 to 12 trillion operations per second with their best chips today. And that's great news for ARM because they make their money on the royalties from the number of ARM-based chips that are sold. I guarantee there will be a lot of companies that will want to compete with Microsoft's Copilot AI computers. And ARM is the only chip on the block. The reason this is telling is because Apple finally got into the AI race, and they announced a couple months back on how all their hardware moving forward is going to have Apple Intelligence. Clearly, it's a little bit of a play on AI, which is a new suite of AI features for their iPhone, their Mac, and all other Apple devices. And this Apple Intelligence requires on-device processing with a huge emphasis on privacy. But once again, all of this new hardware is running on ARM-based processors that Apple is designing themselves. And it is the high-end processors that don't come cheap for both production and the royalties to ARM. And of course, we're all hearing how AI is driving up GPU purchases for cloud-based companies like Amazon and Google, where Amazon's AWS has custom designed its own server processors with ARM with a recent announcement.
We have breaking news on Amazon. Kate Rooney has the details. Kate.
Hey there, Morgan. Amazon just announcing its latest version of a custom-designed chip. This newer version brings 30% better performance versus some of the previous generations. Say it uses 60% less energy to process the same workloads, keep costs down. Amazon is partnering with ARM for the chip architecture, while AWS is working on its own in-house chip.
And Google has done the exact same thing with its Axion chips. And if these large companies are buying all the server GPUs available for the next year, then guess what? They're also going to need processors to go with it. One hand leads the other, and ARM is poised for a lot of growth. Okay, that sounds really weird when you think about the anatomy of it all. And the reasons that companies like ARM processors so much, it's because they can design them for specific tasks. They're also easily customizable. They come with lower power consumptions for its performance, and the obvious reason, they cost less. The ARM processors are in almost all edge devices from smartphones, Internet of Things, 5G modem chips, and even Tesla vehicles use ARM architecture for its self-driving and its infotainment systems. When we look at the performance of the stock, in just the past month it's up 32%. And year to date, it's up even higher at 145%. And when we look at the revenue each year, it has had consistent strong growth. and that isn't slowing down anytime soon. Analysts are predicting a compounding annual growth rate for ARM at 22% for the next couple of years. Overall, this is a great company that I believe is a bit overpriced today, but when it has a dip, then I'm obviously going to buy more. This is a long-term play for me because I know that the demand is already there, and it will continue to be there for several years. But are you curious which asset is rarely overpriced? Well, that happens to be gold, which, if you look at this chart, it has consistently performed well against the S&P 500. Which brings us to today's sponsor, Nevada Canyon Gold, where its stock is up over 23% year to date, where they are not indexed to gold, but rather they build their equity from royalty interests, precious metal streams, and exploration accelerators. They operate solely in Nevada, and they facilitate capital investments with up-and-coming miners and prospectors. Nevada Canyon Gold has the expertise to guide others that own all that expensive capital expenditures to earn and mine more resources. This model is extremely lucrative for Nevada Canyon Gold because they aren't heavy in debt in all of that expensive equipment that's required from this industry. They just support the companies that do. And if you're interested in learning more, please check out their ticker symbol NGLD or use the link below. The next company is still part of that Tier 1 and Tier 2 of growth, and that would be Qualcomm. It ties in well with ARM because Qualcomm's Snapdragon X Plus processor, it happens to be that new chip that I referenced earlier, is the only chip in town that met Microsoft's requirements to be in its AI Copilot PCs, with that 40 trillion operations per second. This Orion CPU will be found in a lot of high-end laptops and competing against Apple's M3 chip. I need to state that Qualcomm doesn't manufacture any chips itself. They design them using the ARM infrastructure. For that reason, both companies will either sink or rise with the tide together. Most everything that I spoke about with ARM ties in exactly with Qualcomm. And now I'm just going to shift straight to the financials. When we look at the stock for the trailing 12 months, it's up 76%. The 3-year CAGR is 15.5%, and the 5-year CAGR is a solid 24.4%. That means that $10,000 invested 5 years ago would be worth over $29,000 today. I see Qualcomm to be a cash cow. I don't see them blowing up as quickly as NVIDIA anytime soon, but they design most of the edge chips that are in all of our mobile electronics. And now that laptops are offered with some high-end Snapdragon processors, they may be growing a lot faster than expected. The next company is Arista Networks, and they definitely fall within that second tier of the growth cycle for AI expansion. They design and sell cloud networking solutions for large data centers and routing environments. All the large data centers like Amazon, Google, and Microsoft, they're all updating all of their hardware to manage that massive drag on resources that AI puts on them. A major part of that infrastructure is the networking hardware, and that's where Arista Networks steps in. Their whole intent is to build scalable, high-performance, and low-latency networks for cloud computing and data center environments. The point of interest is that Arista is developing AI-specific infrastructure specific to GPU interconnects. The networks happen to manage the traffic of data, and the faster the traffic is managed, well, the quicker the models can learn, and the faster that we can get our answers to our endless requests to ChatGPT on the best restaurants for our next vacation. And in looking at the performance, the trailing 12-month is very high at over 129%, and the 3 and 5-year CAGRs are wildly high at 58 and 40% respectively. And their income statement shows substantial growth in revenue over the past 8 years. This is also true of their net income. $10,000 invested 5 years ago with Arista would be worth over $55,000 today. When you marry up a company with strong fundamentals and an obvious path for growth, then once again you have yourself another cash cow. I've owned Arista for a while now, and I'm still buying it to take advantage of dollar cost averaging. It may be going up and down in the short term, but over the next 10 years, I'll gladly write it out. Just a quick reminder that I do have a link to a free spreadsheet down in the description with all of these stocks that I'm speaking to. And if you'd like to have visibility to my personal investment allocation, I do share it in my free newsletter that I send out quarterly. And you're probably asking yourself, why so infrequent? It's because I really don't want to bog down everyone's emails unless I have something important to say. So feel free to sign up. The next company is Supermicro, which designs and builds high-performance, energy-efficient servers, storage systems, networking devices, and other IT infrastructure solutions. They may sound similar because they are a direct competitor to Arista Networks. And for that reason, Let's compare the financials between the two of them for their 2023 year performance. In looking at this table, Supermicro has more revenue and growing at a faster pace year over year at 37%. But the gross margin, it's pretty low at 15% compared to Arista Networks' 61%. The same is true for the operating and the net income, where Arista Networks is much higher. But the demand and growth for Supermicro, it's giving it a lot of tailwind, where analysts see it on average having 19% upside for the year. And in looking at the performance, the trailing 12 months is at the highest of all of those today at 270%. And I do want to call out that the 5-year CAGR is at 114%. It may seem a little late to get in the game, but their business will be on fire for several years to keep up with all the upgrades that those big companies are making within their GPUs and all their processors. And if you had invested $10,000 with Supermicro 5 years ago, it would be worth over $448,000 today. I'll be sharing more AI companies in the second and the third tiers of growth over the next couple of months. I hope that you got some value from today's video, and if you feel like I've earned it, I would greatly appreciate it if you'd consider pressing the like button and also consider subscribing. Thanks again.